Hello and welcome to the first Investment and Wealth Insight Report of 2024 from Nedbank Private Wealth. 60 minutes where we'll take you through what is happening with the economy and investment markets and how that could impact you. Insights into your wealth and what you should be considering when planning for the future. Broadcasting live from our studios here in London, we've got viewers joining us from all over the world. So hello, and it's fantastic that you've been able to join us wherever you are. But before we get into the show itself, I just want to take a quick moment to make you aware that unfortunately Dr. Tamsin Lewis is unable to join us today to discuss longevity as was planned, but we'll make sure that you don't miss out by having her on a future show. And don't worry, because we've still got a packed lineup for you. So let's get on with it. Coming up, Simon Prescott, Head of Wealth Planning, will be joining us again, this time to discuss the highlights of the UK budget, as well as emotionless investing and the collaborative approach his team take to wealth planning. And then I'm going to be handing over to Chief Investment Officer Tom Caddick, who will be joined by portfolio strategist Louis Hutchings for an investment update on what's happening with investment markets. And then it's back here to the studio where I'll be welcoming senior private bankers Ali Kirk and Hugh Williams to discuss planning for a life-changing event and how they support their clients through those periods of their lives. And Katie Warwick, Head of London Residential Research for one of the world's leading property agents, Savills. She's going to be taking us through the outlook for the property market. And then finally, wrapping up the show, we'll have Katie and Simon back to answer your questions live. So please make sure if you send in any questions, then what you want to do is just go through the panel that is on your screen and then we can get to them. But first, I'm once again joined by Simon Prescott, who's going to talk to us about emotionless investing and also give us his thoughts on the recent UK budget. So welcome back, Simon.
Good morning.
So you've done a few shows now, haven't you? Yeah. For those who are tuning in for the first time, could you perhaps give us just a quick recap on what your team does and also how you differ to what our viewers might think private bankers offer?
Yeah, sure. So how we set up as an organisation, we have a brilliant team of relationship managers and private bankers who look after the general day-to-day relationship with their clients. But we really recognise that not one single individual can know everything about this complex financial services industry we operate in.
Yeah.
So we surround our private bankers by specialists. And we have investment specialists, and you'll hear from Tom and Louis in a little while. We have credit specialists, and then we have my team, which is the wealth planning specialists. And what we aim to do with every single one of our clients is create a bespoke wealth plan for them, which basically shows how, if we look at all your life, your objectives, everything you want to achieve, how we can help you achieve those objectives through your finances.
Okay.
So basically, we almost know that, you know, if you have a goal or an objective in life, and no matter what area, whether it's sport or wherever, if you don't have detailed steps to achieve those objectives, you're less likely to achieve it. So we want a plan bespoke to you with detailed steps to how you're going to have a great life.
And so how specifically do you go about helping people meet those goals?
Yeah, so how we do this, we have to ask lots and lots of questions of client, but not just asking lots of questions, it's actually listening to what they're telling us. And before we start to tell clients what we do, we need to understand why we're going to do that.
Yeah.
So it's understanding, you know, things like the hard data, the assets, the liabilities, how much they want to spend and so forth. But again, what a future life might look like for them. And that's really, really important in our mind. On saying, you know, what do you want to achieve in life? When do you want to achieve it? And then with all of that data, we can critically analyse a client's situation. We can map it out over the next 10, 20, 30 years. And we use a piece of sophisticated software called Cashflow that allows us to number crunch and then present it back to a client in an attractive and easy to understand manner. And probably when they see the financial future for the first time, it will probably be them seeing the financial future for the first time in such an easy to understand format.
Oh, very good. And I think actually that particular cash flow planning, we've popped a link to that page into the panel on your screen, so you can jump into more detail on that topic, but not just yet, obviously, because we want you to stay for this show, but afterwards. So, Simon, you're also here today to talk about the UK budget, but also emotionless investing.
Yeah, so we'll come on to the budget. But I sometimes think that when clients come to see us, because we're going to talk about the finances, they may think we're going to start talking about the budget, about tax, and about pensions or structures. And whilst we will talk about that, it's almost, they'll say, secondary. So what I mean, Gemma, if I sat you down in my office and said, great, lovely to see you today, let's talk to you about your pensions. Okay, it's probably not the most exciting conversation you're going to have.
Yeah, I know what you mean. It's kind of like a necessary evil. It's fine, but it sounds a bit dry, a bit dull.
I mean,
Yeah.
look, I find these things
even though you've not,
quite
you've got to
exciting,
do it.
right?
Yeah, it
Absolutely.
takes all sorts, Simon. That's why we need you.
For sure. But if we change that conversation to say, well, actually, what does post-work living look like? What does retirement look like? Let's get you excited about what your future life's going to be.
Yeah, instantly to me, that's more colourful, that's more interesting.
Different conversation,
Yeah,
absolutely. Now, we will have to talk about pensions, okay? Because they form a part of making this life great for you. But it's not the thing perhaps we want to talk about first of all. We want to really talk about you, what's going to look great to you, what's exciting in the future, and how we can make your assets achieve that for you. And that's the plan.
So in other words, feelings and emotions, I mean, it's quite obvious, but they're really important.
Yeah, for sure. And you know, on the title, we put emotionless investing. Okay, we can never, unfortunately, make anything emotionless, okay? Because as humans, we are emotional creatures. All right, and we've spoken in previous webinars about hundreds of thousands of years of evolution. We make decisions based upon emotions, and that's one of the things that actually makes us uniquely human. So we can't get away from emotions. But emotions are powerful, right? So excitement and fear, sometimes they make us do some crazy things, right? And ironically, both of those are driven by the same chemical, which is adrenaline, which is the fight or flight response. Okay. So if we take, for example, let's have a look at the stock market. Or, you know, if you've invested and you see your money fall and we have a market crash and your money falls 20%, that's not going to feel great, first of all.
Sure.
Fear starts to kick in.
Yeah.
My hard-earned money's being lost. And what can happen in those moments? Emotions kick in. You may then want to take your money out when you've already lost money. Now, we could say you're being irrational, all right? But in that moment, you've done your research, okay? You've listened to the news, you've read the media that has told you that the world's going to hell because they lead on the negative bias. And you think you feel safer in that moment. So you're making a rational decision in your mind. So there's no point me telling you you're being irrational because we're going to butt up against each other.
It's like telling someone to calm down. It never works.
No, absolutely not. So we've got to recognise that emotions will influence decision. And probably what's happened in that moment, you've lost composure. Okay, and so an emotional, powerful feelings come through you and your composure in that moment has been lessened.
Yeah.
Now, we've done a plan over maybe 10, 20, 30 years to achieve all these fantastic things you want to do. But in the short term, your view and your lens has come right to the short term, you've lost composure.
Yeah.
So we need to extend that composure back out to your long-term time horizon to make sure you're not making any poor decision making.
Okay, so just to help our viewers get their head around this, you usually come with an analogy. So what's today's analogy?
So I think in the past, what have we talked about?
We've
Horses.
done all sorts. Horses, mountaineering, I think.
Mountaineers. We're going to keep going up into the air. Today I'm going to talk about pilots. I think next time I'm going to have to talk about something in space.
Space rockets,
keep going up. But at the risk of offending pilots world over, a pilot's job is quite boring in most of the times. Okay, you take off, you fly, you land. I've simplified, of course, but in that period it's quite boring. Interspersed by moments of sheer terror. Okay, something goes wrong.
Yeah.
Now, the pilot through their training, they'll have put through hundreds, if not thousands of hours of simulations so that when those moments of sheer terror occur, emotions will be flying through, adrenaline will pump through their body because of fight or flight, but they're able to regain and keep composure because they've been put in that position. So the composure is fine, they react, they get you safely down. Looking at investments, as I said, investments should also be boring. Okay, 3 times out of 4 on average, the markets go up. That's a pretty good percentage rate, but occasionally we'll see a market crash and composure can be lost. Now, as an investor, Gemma, if you invested with us, we don't put you through hundreds of hours of simulation training in that moment. It just happens. Okay, you've got far better things to do in life than us sit you down and talk through. But we need to make sure that in that moment when you are reacting, that you understand why, what you're doing, and how that could influence your long-term
Yeah, and there's no need for panic when things go down.
Correct. It's a natural part of investing in the stock market. They will fall. So it's regaining that composure, trying to cut out the short-term noise. The idea basically being is what we're aiming to achieve for you is investment returns rather than investor returns. Now, investor returns are often lower than investment returns because we panic, because we can make some poor decisions in the short term, and we like to tinker.
Yeah.
Okay? Leave your investments alone, and that will help you achieve investment returns, not investor returns.
Okay, so there's a lot of reassurance in your job as well. Yeah.
Absolutely, absolutely.
Right, let's get to it. The UK budget, which we've just had, sort of, what were your top lines? What was your insight?
Yeah, well, I think looking at what the budget is, we talked a moment then about investment returns and investor returns. What else can pull your money down from investment returns? And what can pull your money down there is things like tax. Okay, are you investing efficiently? Because if you're not investing efficiently and tax is being taken off your returns each year, that's again is pulling your money down. So the second part of our job is the technical side, understanding things like the budget, understanding all the financial services products out there, and there are a lot. And for us to be able to look at all of that information and apply it to your situation or the client situation. So if we look at the budget, for example, and it's quite a long one, I think it was an hour and 20 minutes.
Yeah.
You could have watched all of that, and 2 minutes of that could have been applicable to you.
Sure.
Okay, there was another hour and 15 minutes. You could have been doing something far more exciting than watching the Chancellor deliver a budget.
I'm a bit sad like you. I find these things quite interesting.
Well, as you said, some of us need to.
Yeah, some of us have got to, yeah.
But what we can do as a partner with you, we can disseminate all of that information and work out what's relevant to you and make sure that your money is positioned in that manner so that it works efficiently for you and effectively for you.
Absolutely. Okay, so which were the parts that you particularly thought people should know about, having done the whole hour and 15 minutes?
Yeah, quite. So it's also to recognise here that the UK budget is just that. It's for UK residents.
Yeah, very UK-centric right this second.
Yeah, we've got a lot of viewers that this may not apply to. And also looking at the investment, what Tom and Louis do, it probably doesn't change their outlook. Okay. Because it's centred on the UK. We're global investors, and I'm not too sure China and America are going to change economic policy if the Chancellor messes about with national insurance over here.
Yeah, the 2p cut, yeah.
Correct. So what actually happened for UK residents, there was this 2p cut for national insurance. It's going to help employees, not people who have retired. It would have been nice if it had brought income tax down for people who are retired, but he did frame it as a budget for working people.
Froze the thresholds,
Well, absolutely. So the threshold's been frozen over the last few years. Inflation has eroded that, so it's not the biggest giveaway at all that he put out that it would be. But it's something, okay? It helps with cost of living. There was the UK ISA that is announced, which is an extra £5,000 you can put into an ISA on top of your 20. It's gone into consultation. It should come out sometime next year, but it's £25,000 a year tax-free. As a couple, £50,000, 10 years, £500,000 you can shelter from tax.
Okay.
You know,
when you put it like that,
it's not bad.
Yeah.
There were some changes to capital gains tax on property, on second homes, which Katie will probably cover later on. But other than that, Gemma, it was pretty, not much happened. For a pre-election budget,
it was quite surprising.
More.
Yeah.
There was a big change to what we call the resident non-domicile regime, which, believe it or not, has been around since 1799. So for the tax industry and for us geeks, should I say, that was quite exciting. But there are only around about 58,000 resident non-domicile individuals in the UK, of which this is probably only going to impact 2,000 of them. So for the masses, it wasn't really much. Yeah. We deal with these types of individuals, so you can be assured that we're on this, and any changes if this impacts you as a non-dom individual, we can help you. But just to confirm, it's not just about this one budget. So if we go back to the last budget, it's accumulation of all of these things. The last budget, there were some big changes to pensions. You can put £60,000 in there instead of 40,000, and there was a change to something called the lifetime allowance, which was a tax on pensions above £1 million, which again a lot of our clients have. So it's picking out all of these areas over successive budgets and making sure we apply them to you.
Okie dokie. So just before we run out of time, Simon, what is the takeaway that you'd like to leave us with?
Yeah, so I think just to explain again how we are uniquely set up to look after you, and of course award-winning, we think we do it the best. We will always build a bespoke plan for you to get you from where you are to where you want to be. We'll partner with you to help you with things like emotional decisions, why is this happening? But not just emotional, the technical side, things like tax, structuring, etc. Ultimately, all of this builds to working in partnership with you to help you achieve the life that you want to lead.
Very good indeed. Well, we better go over now to Tom and Louis because they are going to give us an investment update.
Thanks, Gemma. Great to be here. It's been a good time to be invested in the market. Since we last spoke, we've seen strength in equity markets, we've seen strength in the fixed income or bond market, and it really has been a good time for portfolios generally, going into the latter part of last year. Since we last spoke, we've seen real strength, a rally in the equity markets. And we're going to focus primarily on the US market, or the S&P 500, but that's only really for a couple of reasons. Partly because it's an area that we favour for portfolios. We are global investors, so as a natural result of that, we will find a relatively high weighting in the US generally, but it is an area that we favoured over the last year or so. But it's also because there's been some interesting developments in that market. So you may recall at the last update, I talked about something called the Magnificent Seven. Now this is the 7 largest stocks in the US, in the market, that have so much importance. Now, when I spoke last time, I was talking about the rally we saw on the back partly of artificial intelligence. Now, Louis, talk to us. Why is the Magnificent Seven so important and what's been going on since we last spoke?
Yeah, no, definitely. So thanks, Tom. So when we're looking at the US market, it's important just to get really under the bonnet of what it actually is, to understand the drivers. So here we've got the 500 largest companies within the US. But what's important to highlight is that this index is market cap weighted. What does that mean? So really we're looking at the larger a company is, the bigger its weighting in the index, and the greater its overall influence on the S&P's return. So when we're talking about the Magnificent Seven, these are some of the largest companies within the US. Household names, the likes of Apple, Microsoft, Google, we all know them very well, but they've been so successful and now make up such a large component on the S&P 500, they can direct the returns of the broader index. So these stocks account for around about 30% of the broader S&P 500, so huge proportion, and they're able to steer the direction of the broader index. And that's exactly what we saw last year. So with the Magnificent Seven, huge investments in AI, and last year was all about AI. So these companies are very well positioned to benefit from that. What we saw from these stocks were up around 80% together. And like I mentioned, because they take up such a large proportion of the S&P 500, they're able to pull up the broader index. What's interesting though, if you take away the impact of their weight and instead weight all stocks the same, the return of that index would have been around 2%. So huge differences between the two. Since then, we've seen a far more broad-based rally. So here we've seen the Magnificent Seven do very well, but also the other 493 stocks perform well. And that's exactly what we want to see. We like to see a broad-based rally because it shows broad-based confidence in the index.
And that's exactly it, isn't it? There's been that sort of transitional change since the back end of last year where we've seen a much more broad-based rally in strength in markets. But it's not just been about equity markets. Also, the bond or fixed income market, as I said at the very start, has done really well over that period. Now, I'm showing you a chart here that looks like it's going down, but that's about yields. Because don't forget, there's an inverse relationship. Values go up, yields go down. Values go down, yields go up. So what we've seen is a rally in the bond market, seeing values rise as yields fall, as the market has started to price in possibly lower interest rates. And that's been the key story of the last, I would say 3 or 4 months, but actually probably the last year or so. It's all been about inflation and it's all been about base rates. Now, not to go back over this because we've talked about inflation a lot, but inflation has been high and it's come down. Now what the markets are trying to understand is, at what point do central banks pivot? In other words, at what point do they start thinking about cutting rates? Now, cutting rates or going to a lower interest rate environment can be really good for growth, but it can also stimulate inflation. So central banks are trying to walk that fine line between getting inflation under control, but also not killing off growth. In other words, once they start to cut rates, that will stimulate growth and keep the economies going and stop them from sliding into recession. Now, so far, they've done a pretty good job.
They have, and it's a fine balance, isn't it? It's an art as much as it is a science.
But inflation really does matter because it can influence market direction, or at least what markets are expecting central banks to do.
No, it can, and the market has got so fixated on rate cuts over the next few months or so. And what's interesting, we look back to Q3 last year, the market was really expecting the amount of rate cuts to be less, and you saw a strong correlation with the broader S&P 500, around about a 10% fall in returns. What's happened since then, though, is the number of rate cuts being priced in has increased, and with that, we've seen a broad-based rally in the S&P, up around another 17%.
So big swings in the market, largely influenced by the market's expectation of the direction of travel on rates, how fast, how quickly they're going to move downwards. And that's been driving the bond market as well.
No, definitely. And I think what's interesting for us is, as much as, yes, rates are important, but ultimately we know the direction of travel. It doesn't matter when these cuts occur to a certain extent, because the Fed have already told us that rates are too high, rates are restrictive, because their ultimate long-term target is 2.5%. At 5.5%, that's very restrictive territory. So we don't know when the rate cuts are going to occur. We don't know how quickly we're going to move to that 2.5% level. But ultimately, it doesn't really matter, because what we're focused on is how the current rate environment is impacting the broader economy. Economic activity, are we getting inflation under control? And it feels like we are. So it's creating the right platform for growth going forward.
So some really positive news there. But I think it's worth just revisiting why we own equities, or indeed bonds and credit. We think of equities as being probably the most volatile within your portfolios. It tends to, what do we mean by volatility? It's really just the risk, the movement, the swings in price that we see. And there are times, particularly over the short term, when you can see a lot of movement, and it can be quite uncomfortable as an investor, certainly as an asset owner. But it's a love-hate relationship at times. You need the volatility, you need the risk, because you want to be rewarded. We want equities in our portfolios so that you can get the return. And the return is a product of the risk that you take. So they have to exist together. But there are times when it can feel uncomfortable, which is what we've seen recently, because there's quite a lot of volatility in the market. Now, our job is to try to navigate the portfolios, to interpret the environment that we're in, to make sure that they're positioned correctly in the right areas, in the right asset classes, and in the right mix, to make sure that we can navigate through that path. And as Simon was saying earlier, to be able to focus on the bigger picture.
You're totally right. And like you say, it felt like a particularly volatile period the last 6 months or so. But when you take a step back, you can see it's just a blip on the map. So it's about trying to be comfortable with that volatility, even starting to love it if you can, and being comfortable with the fact that you'll be able to generate long-term premiums on the back of being invested for the long term.
Now, just to leave you with a few thoughts, Gemma, I think in general, we're starting to move really quite cautiously optimistic on markets. Central banks seem to have done a good job in terms of managing that fine balance between managing inflation and without killing off economic growth. So we feel like we're starting to move into a more positive environment. There's a lot of activity on the political side. We've just recently had the budget. We've got activity going on with the Fed and the debt ceiling. There's a lot on the geopolitical side, but there always is. There's always something to be able to interpret and navigate. Thinking about the bigger picture is really important, and we are starting to move cautiously optimistic, and maybe, as Louis says, just learning to love volatility just that little bit.
Thank you very much, Tom and Louis. And I think it's really interesting to see volatility as just a blip on a chart when you look over the long term, because it's so easy to get swept up in the panic of what's happening right now, where things can seem like big peaks and troughs. Now, I'm joined by senior private bankers Ali Kirk and Hugh Williams, who are going to talk to us about supporting their clients through life-changing events. So welcome, Ali and Hugh. Lovely to see you both. And let's get straight into it. So, Ali, if we're talking about life-changing events, what specifically do we mean?
So, in my world, a life-changing event is a period of time where a client's circumstances are dramatically altered. Mm-hmm. So, let's think about maybe marriage, birth of children, maybe a windfall. But not all life-changing events are positive. So, clients can be affected negatively by death, ill health, and also by divorce.
Okay, so some of those events are happy events, others not so much, but what are the impacts?
So let's talk about the happy events to start off with. That's happy events such as marriage, the birth of children, and as we know, children are a lifelong commitment, especially when you consider schooling and university costs.
Yeah.
So parents and grandparents may be wondering how they can budget for such a large amount of capital expenditure when it may be so far in the future.
Yeah.
And this is when we need to talk about it and factor it into the wealth plan.
It's so true. They get more expensive as they go along, don't they? Unbelievable. Now, divorce, obviously, you mentioned, huge event that can be very tumultuous for people. Some people might say it's a happy event, others not so much, and it can be really, really unsettling. So I suppose that is one of the key ones.
Of course, and with any type of change, there comes a certain amount of financial vulnerability.
Yeah.
And I think this is when we need to speak to our clients the most, making sure that they can still afford the objectives that they put into their wealth plan at the very start, and just to make sure that they feel comfortable with their financial future.
Okay, yeah, and let's deep dive a little bit into what this support looks like. So Hugh, tell me a bit more about your role.
Sure, so I look after a fair number of divorce clients, and divorce clients, they come to you at a period of great vulnerability, upset, perhaps lack of confidence and trust in their lives.
Sure.
So it's key to form a good relationship from the start, and understanding, listen to what their needs and requirements are. Quite often they'll say, will I have enough money for the future? We don't have the income I used to have in the past. And if they haven't been used to dealing with the finances of the household, then there'll be a vulnerability there, as well as all the other emotions that they're having to go through at the same time.
Yeah.
So if I think of a couple of examples, I've accompanied some clients to view new properties because they're starting out in life. They're having to find a new home for themselves and maybe the children as well. Also been to buy cars for them as well, and even some furniture at one point. Whatever it takes for the particular client and the sensitivities involved, then we're happy to do, and that's how it's a very bespoke personal service that we offer and provide, and it's key in a period in the life of great change, transformation, vulnerability, mixture of emotions, and we need to reassure that we're there for the longer term to basically help them at that period and for the future as well. So it's it dovetails in with doing a wealth plan and all those financial planning requirements that we're able to cover for them as well.
Sounds like you really go the extra mile. At a time, I've been through it myself, it can be very daunting.
Yeah.
You know, there's so much to think about. So I'm sure that sort of added support is very, very welcomed. So we've talked at length on past shows about the importance of wealth planning and the multitude of benefits that come with that. But for somebody who's almost starting again, some life event has happened, is it a case of, okay, scratch the old plan, we're starting again, or is it more sort of tweaking?
Well, some clients would have a wealth plan in place. Some clients would even have 2 wealth plans in place to cover certain eventualities. But if a client didn't have a wealth plan in place, that wouldn't be a problem, because we would sit down with them and we would go at their speed, and we'd comprehensively do a cash flow modelling exercise as part of the wealth plan, and we would be able to demonstrate to them very clearly, very transparently, how their future was going to look and how much money they were going to have for the rest of their lives, how they could budget on that, and then we'd be able to assist them with managing that money and look into the future. So that provides a lot of comfort to clients that are going through periods of huge stress and anxiety at that time.
Okay, so if you're talking about planning for the future and from the outset, are we talking, for instance, right, we're going to get engaged, I've got a lovely dinner planned, I'm going to do a romantic proposal, here's the ring, here's the wealth plan. Like, where does that fit in?
Well, I don't think we want the wealth plan to appear
As part of the dinner.
Most definitely not. There's nothing romantic about talking about wealth and money. But joking aside, the wealth plan and your financial future should most definitely be discussed before the exchange of any rings.
Okay.
The reason for this is that clients can have very different views on wealth and their future. If we look at an example where one client may want to gift all of their money to charity, very much into philanthropy, where we might have another client where they're together, where there's a modern family. And that client wants to gift money to children from a previous relationship. So the two necessarily don't go hand in hand. Nothing to say they can't have separate wealth plans, but it definitely does need to be discussed.
Okay, so iron all of these things out before the big day. That makes sense to me. So I imagine you come across sort of interesting situations quite a lot. Do you have any other examples of where perhaps people might not have foreseen things or things might be difficult?
What we see quite frequently are clients who've been very successful in their careers. They've built successful businesses and then they exit and they're left with a huge windfall. Now, the very nature of their personalities, if they've worked in the business and perhaps neglected their finances, they're left with this amount of money that they've not even planned what to do with.
Right.
And this is where we can help. We will sit down and listen. Work out what they need to do in order for that money to last them the rest of their lifetime.
Yeah.
So we will show them what their money looks like now, what it will look like in the future, and they can make informed decisions from day one.
Yeah, fantastic. What about you?
Yes, I can think of an example of clients that actually they have amassed, a good amount of wealth over a number of years, but they're looking at it through different eyes.
Yeah.
And in the relationship, one party maybe, have certain plans that the other one doesn't have. So we'll be very diplomatic in terms of how we discuss those aspects with the client, dovetail it into their wealth plan, so that both parties achieve the goals and the objectives that they're looking for. So yeah, certainly sometimes there's
there awkward moments?
Well, no, we always manage to smooth through the awkward moments through communication, and it's all about communication, relationship, and understanding what their needs are, and discussing those with them, with all parties, just pure transparency, and then at the end it all works out.
Excellent stuff. Right, we're going to have to leave it there, I'm afraid. But before we do, have you got any important takeaways? What's sort of the main message that you'd like to leave for the viewers?
Well, I would say the most important thing is to have trusted advisors, whether that's your private banker, your lawyer, your tax advisor, accountant. You just need to have those trusted...
For me, it's my hairdresser as well. Yeah, I mean, all of those people too, but I'll add them.
Whoever it is whether you're a trusted advisor and you have a great relationship with them, that's what it's all about.
Yeah.
It's all about the relationship that you've developed over the years. We all, like you say, we all do it in aspect of our life, and particularly when something's as important as finance.
Absolutely.
And wealth planning and wealth management, that's particularly important. So yeah, I'd say,
As you've highlighted, at very important points in people's lives, you do want that trust, don't you?
absolutely, absolutely.
Would you back that up? Would you concur?
Most definitely. Trust your advisors, keep in touch so that we can keep your wealth plan up to date.
Fantastic. Thank you so much. All very valuable information. Thank you, Ali and Hugh. Thank you so much.
Thank you.
Right, time now to explore what's happening with the property market. Since interest rates started to rise, the topic's been all over the media and the subject, of course, of many conversations. So here to hopefully give us a bit of clarity, we're very happy to welcome Katie Warwick, who leads the Savills London Residential Research Team. So thank you so much for joining us and welcome along to the show. And I think I'm right in thinking that you are the person to ask when it comes to the UK housing market.
That's right. Thanks for having me. So I work for Savills in the research team. I'm a director in the team focusing on the UK markets. I have a particular specialism in thinking about London residential market and even more of a specialism on the development market.
Okay.
I work out of the head office, but I have spent some time travelling around, working in different offices around the world. I spent some time in the Singapore office a few years ago, really trying to understand international demand for London property.
Wonderful. It's going to be great to get your expertise today. Okay, so current state of the market, are we looking positive? Is it volatile? Is there uncertainty?
There's a lot of uncertainty. It is still a little bit volatile, but it is eking into a slightly more positive territory. So the good news is that house prices at a UK level have erred into positive territory now. So we are seeing price growth, very minor levels of price growth, which is, of course, a positive sign, but we're not out of the woods yet. There are a number of different indicators that we look at incredibly closely. One of the key ones for a forward-looking indicator is something that we call the RACS balance of opinion. I might need to explain that for you.
Yes, please do.
It's a bunch of chartered surveyors are asked a number of questions as to what they think, the experts in their patch, what they think is happening to the level of new buyer inquiries and the level of new stock coming onto the market. So with those forward-looking views on whether stock is coming up or buyer inquiries are increasing, we can start to get a picture of what might happen to house prices. And at the moment, this sentiment, this survey is showing us that new buyer inquiries have erred into positive territory for the first time since April 2022. So that is a positive sign. But of course, we know that interest rates are a big part of the picture for the housing market. And the base rate, it hasn't started to come down just yet. And the mortgage markets, the mortgage rates are fluctuating a little bit.
Okay. So yes, let's speak a little bit then about prime markets, which I know is your specialist field, isn't it?
That's right. So Savills cover the prime markets incredibly closely, and they do move quite differently. They have different drivers and different buyer types to the more mainstream markets. And I would say the key difference is that a prime purchase is more likely to be discretionary, whereas a mainstream purchase is more likely to be needs-based. And people only have so much money that they can afford to spend on their property in the mainstream market. They're much more constrained by the higher cost of debt at the moment, whereas in the prime markets we know there's much higher levels of cash activity. And so the clear difference that we have different pressures facing these different groups of buyers. The prime markets have been a bit more resilient and have a little bit of a stronger outlook in the short term.
Okay, now interest rates, we all know they're so key, and of course there was that huge shock a while back. But things have settled down, or?
So the base rate hasn't moved. I think the interest rates are key, and the base rate has stuck at 5.25 now for a number of months. And I think once we start to see that come down, then it's a real sign that will be a turning point for the market, and that will start to feed into literally improving what people can afford for their mortgage, for their payment, their housing costs.
Yeah.
But also it's a sentiment point. No one likes to to feel like they're making this big purchase at a time when house prices are falling, and what is the sign for the market that things are going to be turning. So I think that all eyes are on the economic data at the moment, and when we start to see inflation come down a bit more, we start to see a reduction in interest rates.
So there might be quite a lot of people sort of almost waiting in the wings, just waiting for that first nudge.
That's exactly it. So we use, we're not economic forecasters, but we do think about the property market and the impact on the property market. So we use Oxford Economics as our economic forecasters of choice. They are currently forecasting that the base rate will start to come down very, very sort of, incrementally, small changes, but those changes will start to happen in June this year.
Okay.
So that could be the turning point, and then some gradual reduction through the course of the second half of this year.
Okay, now we've obviously just had a budget. How did that specific budget affect the prime markets?
So I'd say the big news from the budget was that there was no big news for property in the budget.
Seems to be the theme, yeah.
There were a few things that we were expecting that didn't happen, but out of the changes that were announced, there was some additional taxation for holiday lets, and there were some relief around multiple dwellings that's now been cut. So
gains tax,
and then there's capital gains tax as well, and that has been reduced from 28% down to 24% for higher tax. For people in the higher tax bracket. There's one other change, which is the abolition of non-dom status, which of course may be familiar to some people who are thinking about this space, because of course that's been Labour's policy. Sure. So the Conservatives have jumped the gun and stolen that from them. So maybe some people were already thinking about this, but certainly that's come into effect a bit quicker than we would have expected.
Yeah. Okay. Let's have a little think then about the global markets. I know specifically you know quite a lot about places like Hong Kong and Dubai and so on.
So we have a world research team, luckily at Savills, and they track the number of world cities. They have an index of thinking about how these prime residential markets are performing. They've got 30 cities within this index, so it's a really good representation of prime property globally. And this index is in 2023, a year of massive uncertainty, high interest rates, a lot of geopolitical uncertainty. The prime markets did still perform they were relatively robust. We saw price growth of 2.2% on average across all of those cities that we track. But there are some outperformers within that, and Dubai in particular, astonishing growth of 17% in 1 year.
That doesn't surprise me. It's really sort of had a moment, has it? And you see it even reflected on things like Instagram, which are a little bit of an indicator of these things. These places get very popular.
It is a very popular place at the moment, and one of the changes, one of the drivers for that is, of course, like the in-migration that we're seeing from other areas of other wealthy areas like Russia, Ukraine. We're seeing some people move through there. That has been a driver for their local property market. On the other hand, areas like Hong Kong have seen prices fall. Even in the last 6 months, they've seen prices fall there by 4%. And the reason for that is, it's heavily linked to interest rates. It's also sort of linked to the China economy as well. So we do think that there's maybe a little bit more of a boost coming to the Hong Kong market, because their government has they've set some tax changes to basically try and address the fact that the property prices are falling, to try and to boost demand. They've provided some tax cuts on stamp duty for second homes.
Okay,
so we might see a bit of a boost there.
That's really interesting. And we've obviously got a year ahead with general elections on the horizon, not just here, all over the place. So as much as you can, crystal ball time, if we have a Labour government, which is looking very, very likely, how would that affect the top end of the housing market?
Yeah, this is something we think about quite a lot, and because of course previously under a Corbyn Labour government there was definitely some stronger proposals for wealth taxes, mansion tax. I don't know if you remember that. That was something that lots of property developers in prime London were sort of very scathing about. That didn't go down well at all. Obviously it didn't come into play, but that isn't on the cards now. That isn't what this current Labour government are proposing. What they are looking at is some removal of VAT VAT exemption on private schools. Yep. They're looking to introduce an additional tax on overseas buyers, but of course the Conservative government have also been introducing extra taxes for overseas buyers over the course of the last few years.
There's not that much in them, really, is
there's
there?
There's not that same polarisation that we have seen in the past. But the one thing that is a niggling thought for me is that the fact that maybe, you know, in the latest budget we've seen the abolition of non-dom status. You know, that was really the Labour policy for focusing on the wealthy here. And will they bring in something else? You know, we don't know yet. We don't have visibility of that, but there could be, couldn't there? It feels like there could be something else.
Spending, and now that's going to go towards the cost of the NI cut. So yes,
exactly.
Yeah, jigsaw pieces. It's like a puzzle, isn't it?
Absolutely.
Yeah. Okay, so let's have a little think then about the general outlook as much as we can. Can you at Savills do that? Do you look ahead in that way?
We do. That's one of the first question we're often asked by any of our clients is, you know, what next? Great, you're tracking what's happened in the past, but what next? And we do some residential forecasts. We publish them every November. So I can talk a bit about what we published back in November, but also about like what our latest thinking is about where that's heading. Because as I started off, you know, the first couple of months of this year have been a bit more positive than we had expected. So what we published for the UK markets back in November, we thought that 2024 we would still continue to see price falls. We were expecting falls of -3% at a UK level, -4% for London, because the affordability levels compared to incomes, house price to income ratios, they're so stretched in London, much more so than the rest of the country. So we thought the price falls would be a little bit stronger in London. And in actual fact, we've started to return to price growth. So maybe we have already bottomed out. We're still cautious about calling that. Some of our competitors have reforecast and are now forecasting price growth for 2024. We're holding off, we're a little bit more cautious. But certainly over the longer term, you know, once we start to return to a level of stronger economic growth, as we start to see, you know, a bit more positive sentiment comes a lot into certainly thinking about the outlook for the prime markets. We start to move past the general election and into this more positive world. In 2026, we start to see much stronger house price growth.
Yeah, I can also understand sort of the prudence, if you like, in being a little bit overcautious rather than over-optimistic for your clients.
It's a more comfortable position for me to be in, certainly, but it's nice to be able to talk about, you know, there's an upside to these figures. And we're certainly tracking all of the economic indicators and the other forward-looking property indicators on a day-to-day basis across the research team.
Okay, now in terms of investors, let's talk a little bit about the reform bill. So this is going to impact rental markets, but can you tell us a little bit about what the bill is and what it means?
Yeah, sure. So the Renters Reform Bill, again, it's a topic that we're talking about a lot in the industry because it is quite a significant change. We don't often have regulation change in this market, and it will be, what it really means is it's going to be shifting the power away from landlords towards the tenants, and it's generally positive in all ways that it's looking to affect the market there. The abolition of Section 21 is the main thing that's being talked about, and that is where landlords will now need to, once this works its way through Parliament and comes into force in the next couple of months likely, landlords will need to have a valid reason to evict that tenant, whereas at the moment they don't need a reason, they can just do it. So some of those reasons, you know, a reasonable reason to be able to evict your tenant would be if the landlord wants to move in themselves, or they want to sell that asset and do something else with it.
Because if you break your contract, obviously you can be evicted. So this is to just prevent perhaps if a family have settled, they've moved to be near a school or something, and then literally 2 months later it's like you've got to go.
Exactly, it gives people a lot more security, and it's also sort of basically trying to target bad behaviour of rogue landlords. That is essentially what this new rule is trying to do. So it shouldn't really change the status quo too much, but we know that with any of these changes, some landlords are feeling a bit twitchy, and it's putting them off a little bit.
Okay. So there has been a lot for the rental market to contend with, because obviously we've talked about the interest rises and so on, but that really then goes on to impact the rental market, doesn't it?
Exactly. So where you see, we're seeing strong rental growth. We have seen really strong rental growth over the last couple of years, and if, for example, in London during the pandemic, rents fell about 10%. But in that period afterwards, we saw this real burst of activity. And in the period since then, we've seen around 30% growth in rents in London, and that is really
a lot for people when wages haven't gone up in that way.
They haven't. Wages certainly haven't been tracking rental growth in this way. So they are very unsustainable. It's very unaffordable for renters to be able, and there's also a limited amount of rental stock. So it's not just about the rent that people can afford to pay. They can't find the right properties for them that they can afford.
Supply and demand pushes the price up. Yeah,
exactly.
Yeah. Okay. So how are we looking then at the moment? Are things slowing down, or is it?
Yeah. So in fact, London has now this month seen the first monthly falls, according to Zoopla, of minus 0.1%. So very minor rental falls, but certainly going some way to demonstrating that a limit has been hit in terms of, that ceiling of affordability. So we have seen that turning point in the market.
It's for the best. I can't have my children living with me forever.
And that is one of the consequences, right? Because they just can't afford to.
Absolutely. Yeah. There's a lot of 30-year-olds still hanging around at home because, Right, let's talk a bit about investors then and challenges for them in terms of the rental market.
Yeah, of which there have been many. So, even going back to 2016 with the mortgage interest tax relief, so some tax changes that were, essentially just making the buy-to-let market less profitable for landlords. So, they're having to pay more tax. They've benefited potentially from the rental growth that we're seeing at the moment, but actually the forecast for rental growth going forward isn't as strong as what we've seen over the last couple of years. So there's a potentially less positive situation for them thinking about the next couple of years. There's also the tax changes. There's been additional sort of tax. The tax situation that makes it just a bit less favourable for them, as well as all of the regulation. So with the Renters Reform Bill and the things that we've just mentioned, it's just a number of these different changes just makes it a very difficult environment to sort of enter for any new investors coming in, but also for those looking to potentially rationalise their portfolios. The other thing that we haven't talked about yet is energy, another form of regulation that was planning on being introduced, and there was a sudden U-turn from Rishi Sunak at the end of last year, was around energy efficiency of residential rental properties. So we have this legislation for the commercial sector. It was due to be implemented, I think, later this year or maybe next year for rental properties to reach a certain EPC level. And actually that's now been abolished. But there were definitely some landlords thinking, what are the costs I'm now paying a lot with my mortgage, the cost of my mortgage on this property. If I need to invest a lot of money in insulating it and bringing it up to the energy standards that are required, again, it's more of an investment in that property that they perhaps weren't bargaining for. So we were seeing, a few more landlords leaving the sector on that basis.
And I guess I understand that U-turn then if that was going to be passed on to renters who already, okay. Right. Is there anything area specific that our viewers should be aware of?
I suppose the strongest markets, if you were thinking about sort of where it's going to be outperforming, because we can talk a lot about averages, but prime central London is where we think the strength of the market is, and certainly thinking about those wealth corridors coming out of prime central London down sort of the southwest, down the A3 through Surrey. Those are the areas that they're very, that they see very wealthy buyers buying properties there. There's a lot more cash in these markets. They're not so constrained by, affordability and the reliance on mortgage debt. And it's also a bit more of a discretionary purchase. So, this is the market that has still continued to see the levels of activity in the super prime markets through these times of uncertainty.
When you say central London, do you literally mean on the tube map or?
So we have different definitions, but prime central London, I would say, is, think about sort of the royal parks, think about, Kensington and Chelsea, Westminster, up to Marylebone, Belgravia.
Okay, excellent. And what about internationally?
Yeah, so as I mentioned before, Dubai has had a real sort of strong bull run of it, 17% growth in 1 year, which is extraordinary. I would say that that's definitely not going to continue at that same rate.
Okay.
I think that there's likely to be, there's still likely to be strong growth of around 6% in that sort of market is what our world research forecasts are. And also Hong Kong may see a bit of a boost, obviously, from these tax changes that I mentioned earlier. So those are two markets that, you know,
keep an eye on.
And then London, where London sits on the global stage, I think prime central London, having seen sort of quite, you know, unexciting levels of growth in the past, and actually it's seen sort of successive small price falls over the last sort of 9 years. Since 2014, which was the previous peak, we're now down 19% in terms of nominal values. And if you think about how international prime central London is, a lot of buyers will be buying based, you know, from other currencies. And if you convert that sort of that total saving for those, if they were buying in US dollars, that saving would be 40%. So if we think about sort of London on the global stage and where it sits relative to other cities, I would imagine it's looking quite positive.
Great. Oh, that's all so interesting. Thank you so much, Katie. And it'd be lovely if you come back again in the future to update us on all sorts of things, specifically how things are evolving in the housing market, because I think our viewers will have found that really interesting. But also stay there, because we're going to do some question and answer. Speaking of which, if you have any burning questions for Katie, she's going to be staying with us for the Q&A, which is coming up next. So thank you so much to those of you who have already sent in your questions. There is still time. There's this panel on your screen, so please do keep them coming in. And while you're getting those final questions in, a quick reminder that if you missed anything today or you'd like to rewatch it, you will receive an email after the show with a link to the on-demand version. These are also available, along with many other videos and content, on the Nedbank Private Wealth YouTube channel and LinkedIn page. Now, the details for both of these are on the screen now, and don't forget that the link to the cash flow planning page and that great introduction to cash flow planning video that Simon mentioned earlier is also in the panel on your screen. So please remember to give that a click after the show. But now it is question time. So Simon's back, Katie's staying, so thank you very much for staying for this part. Okay, let's get started with question 1, which I believe is for Simon. So somebody has asked, I'm looking to move back to the UK. I am tax resident in another country, but I have remained UK domiciled. Is that how you pronounce it? Domiciled? Yeah. I think I did. Yeah, I did that well, didn't I? Yeah, I just went with a guess and I went for it. UK domicile. What should I be considering ahead of the move?
Yeah, so it's interesting you said UK domicile, because that's one of the things that in the budget was announced. They're going to change this concept of domicile. It's got to go into a consultation period, but that's that 1799 tax regime that it's been in so far. Yes. So that will change. But I think for this particular individual, if they're moving back to the UK, it sounds like there's a complete reset or change of their life anyway, whether that move is a retirement or working. Where we would look to work with such a client is, again, building a plan. You know, we know that if we plan over 20, 30 years or so, it's never going to work fully because life's changed. And in this instance, if that client's coming back to the UK, we need to look at things like their investments that they've got at the moment. There's something they need to change on that. And we can potentially do what's called bed and breakfasting. So you could wash out tax gains. You need to be careful on the jurisdiction you're in that you're not creating a tax event there. And we're not tax advisors, so we would bring in a tax advisor on this. But there might be a change of their investments. They might need a complete reset to look at now their future, which could be different from before. And again, if you've been living overseas, you might have collected a lot of investments in different currencies. So you may want to bring them back into sterling.
Yeah.
We have a full treasury desk that can help with foreign exchange for you as well, and making sure you're getting best value from that. But it's a wide question. There's a lot of things we can do. But if you are coming back to the UK, make sure that before you step foot back into the UK, you've done some planning. And ideally, you need to start that planning 12 months before you come back to the UK. Don't just step straight into the UK, become UK resident, because any planning is possibly too late from a tax point of view.
Okay, so there you go. I hope that was really clear. And it says looking to move back to the UK, but great advice. Give it a year of planning.
Definitely,
at least
definitely.
Ahead of that. And it sounds like also the short answer is there are lots of things to be considering, which is why you're there, right?
Yeah, absolutely, yeah.
Okay, right, I've got another question. This is also for Simon, and this person has said, I'd like to give my family their inheritance early so I can see them enjoy it while I'm around. I totally get that. But would doing it this way actually retract from what they would get if I left it to them in my will, which I guess is the more conventional way?
Right. Okay. So I speak a lot to our clients about this because once we've got your plan and we've mapped out what you need in your lifetime, what's left? Okay. Now you can do a number of things with that what's left. You can either spend more, enjoy yourself more, or you're saying that what's left can start to then go through to your beneficiaries. Do you want to be the richest person in the graveyard? Okay. Probably not. But also, do you want your children and grandchildren to enjoy your money after you're dead when you can't see it? Yeah. So if we can work out in a plan how much you actually need to meet all of your objectives and there's a sum left, absolutely. Let's work on gifting now because you will share in that joy then. You know, you talked about property, bank of mum and dad or grandma and grandmother, whoever it may be these days. You know,
but I'd imagine there are quite a lot of implications to take into account if you do it that way.
Well, it can depend, again, on your tax position. In the UK, if you're a UK resident, after gifting, you have to survive for 7 years, or else that's pulled back into inheritance tax.
Can I have it back?
Yeah, there's always a risk of course, gifting, that if you gift a big sum of money and then that goes into children and then a marriage dissolves or something, there's possibly issues there. We can look at things like this. We was talking about prenups, I think, before with Ali and Hughes. Lots of things we can do, but definitely, please don't be the richest person in the graveyard. Okay, either spend it or sharing that gifting with your children.
Yeah, it makes sense.
A lot of joy.
Great question. Okay, one for you, Katie. What impact is the rental market squeeze going to have overall?
It's
a hard one to solve, isn't it?
It is, and it really comes down to supply and demand, and there is really strong levels of rental demand for rent. There's a lot of people who can't afford to buy their own home, so the affordability crisis, does play into feeding that demand. And on the supply side, again, thinking about some of the issues that we've already talked about, we do see that there are some landlords that are leaving the sector that are rationalising their portfolios. So thinking about that supply-demand imbalance, there is still a gap between it, which is putting pressure on rents. So we do think that there will still continue to be rental growth over the course of the next 5 years is the period that we forecast for. However, it is likely to be held back by rental affordability.
Okay, I've got another one for you. And it touches a little on what we were talking about earlier, but is a little bit more perhaps forensic. So with the impending general election, what is the short and the medium term outlook for the property market? It's what everybody's thinking about, isn't it? This general election, and none of us know when it's going to be.
Well, I think that's the main thing, isn't it? It's causing a lot of uncertainty, and it's very uncomfortable.
I know, in a way, can we just get on with it?
I know. So there are inevitably some people who are waiting to see and won't make. Buying a property is a big purchase.
Yeah, so whether if
you're upsizing or if you're a first-time buyer, it's one of the biggest purchases you'll ever make. So people want to make sure that they're in the right position, but it also, of course, coincides with this period of high interest rates where, if you believe the Oxford Economics forecast that we've been plugging in, if rates are going to start coming down in the second half of the year, you would reasonably probably wait, wouldn't you, to try and secure that sort of more favourable mortgage.
Yeah.
Whether that coincides so much with the general election as well, hopefully I think probably Q3 of this year feels the most likely. That could coincide with rates starting to decline. You could start to see a pickup in activity after the general election. So the other point about the general election, and this sort of feeds into our world cities sort of outlook as well, is thinking it's just generally uncertainty, and people don't like making big decisions at times of uncertainty. So you do tend to see a bit of waiting and seeing until there might be a new policy that favours them in some way if they just sort of wait for a bit more information and are in a better position to make that move.
Sure. With changes in the tax regime to both buy-to-let and holiday-let properties following the budget, will this affect the values of holiday homes? And do you anticipate that landlords may look to sell some or all of their property portfolios accordingly?
Yeah. So the tax changes do mean basically that the running costs of running a holiday home are likely to be higher. So, to what extent can those landlords pass on the costs to, people looking to rent a holiday home? I'm sure that will be what they'll try and do, but there will probably be a cap to how much people will be able to afford to pay for that. So to some extent, those landlords might have to just absorb those costs, and then that makes people think about their investment and, how profitable is it? And if it's on the fine balance, then it might just be, that thing for people sitting on the fence, it might just be the thing that tips them over the edge. And the same logic probably applies to buy-to-let landlords.
Yeah.
It's just one more tax change here. And then also, especially coupled with the recent change in capital gains tax, reducing the tax from 28 to 24%. I would say for anyone sitting on the fence at the moment, especially if they're thinking, there's a lot of regulation, or I don't really know what, feeling a bit uncertain about it, that might just be like, I'll sell now because Labour might come in and reverse that.
Put it back up,
We're seeing a few of our clients selling out of buy-to-let as well. What we're tending to find is perhaps at the older age, maybe 65, 70, just saying we've had enough. And you know what? They've had a good run though, haven't they? They've had a great run, and it sounds as though it will continue. But this is back to their feelings, their view, and just saying it feels hard work. And as a 70-year-old. Perhaps if I can release that money, holiday, do everything I want, then I'm going to do that.
Yeah, without having to manage something. Yeah, I get that. Okay, so with interest rates staying higher for longer, do you anticipate further falls in property? We've sort of covered this one, haven't we, in property values in 2024. But this is the question. If so, what is the estimated percentage?
Okay, so our published forecasts suggest that UK property we're going to go down 3% this year in 2024. We now think that things have been looking a bit more positive. I would be, this isn't our published view, but I would go as far as to say I think they're going to be flat this year. So I think, maybe we've bottomed out, maybe even if there's a little bit further to fall in the uncertainty that we might see in this sort of second quarter of the year, I think the pickup that we'll likely see in the second half of the year should sort of balance that out. I'd say it'll be flat this year.
Okay, and what about the mortgage lenders? Have they become increasingly cautious in light of all the economic volatility and all the things we've talked about?
Exactly, that's exactly right. So there's one thing, there's the base rate, which obviously the mortgage lenders need to pay attention to, but they also can charge their own mortgage rates to try and attract business. And the one thing that is different at the moment compared to, say, the financial crisis is that the mortgage lenders, they need to lend. They are businesses and they need to deploy this money. And so there has been a little bit of fluctuation around the mortgage rates that have been coming down below the base rate. But there's been a bit of volatility even in the last couple of weeks where mortgage rates have started to increase again. So they're, for example, 50 basis points higher than they were 2 weeks ago, but they're still 150 basis points lower than what they were 6 months ago. And all of this fluctuation is while the base rate has been stable at this higher level, of course.
It's all timing, and much of it, for some people, luck as to when their latest agreement ends, right?
You can't control when your fixed rates. Yeah, exactly.
Right, Simon, is a wealth plan a legally binding document? So this person says, for example, if we entered into a joint wealth plan, are we both bound by it? And would we have to jointly agree to changes, or would I still need to consider a prenup?
Okay, I think there's a few things being mixed there, but just no, the wealth plan is not a legally binding document at all. It's the way of trying to forecast the future and make your assets meet the kind of future that you want. So I couldn't specifically say, okay, in 10 years you said X, you have to do it now or else you're breaking any legal agreement. Future's not set, right? So no, it's certainly not a legally binding agreement at all. Fortunately, we have freedoms in this country. It's your money, okay? It's up to you to spend it how you want. We can advise you in the best way to deploy it and spend it. But
a plan, and
it's
you
exactly
can change your
that.
mind.
It's a plan. Yeah.
Great stuff. So hopefully that reassures. So the prenup bit, separate.
Well, a prenup might fit into a plan, absolutely, on how to protect your wealth, because it's not just about how you spend it and how you enjoy it, it's also how you protect it. And the question before about gifting money before dying, there may be a concern, and it may prevent people gifting money to beneficiaries if they're saying, I'm not too sure if that marriage is going to last. So, or indeed if they're going to get married and it might not last. There's all kinds of questions that come up. So pre-marriage, there might be a prenup in place that the parents say, if we're going to give you this money, put it in place. If they're already married, there might be a post-nup that they might want to put in place.
Okay.
So it will fit into a plan, and they're
Yeah.
kind of like the legal side, but the plan itself is not a legally binding agreement. Maybe we should do, though, because if we know that a client is going to make it, go away from your plan, and you know it's not going to make sense for them, perhaps we should say, you can't do it. Well,
maybe.
okay. Freedom of choice.
Yeah, absolutely. So, Simon, another one. Would completing a wealth plan with you only take into account the investments, etc., that I hold with you?
No, not at all. And
everything.
There's no point doing that, because all we're looking then is a certain part of your finances.
Yeah.
We're not seeing the whole picture. So it's almost pointless then, because we're viewing everything through the lens of just a single investment. And you've got so much more going on in your life, your assets. We really need to see the whole picture to make sure we can have this successful future for you.
Okay, and last question that we've got here, Simon. Can you purchase gold, silver and crypto through the bank?
So not directly. So if you're wanting to hold gold bullion, we can't do that. We don't have big safes or big vaults full of gold.
Oh.
Shame. Yeah. So we could buy them through what we call index trackers. Or exchange traded funds which track the value of gold or precious metal or silver.
Yeah.
Again, the same with crypto. We don't hold crypto directly, but you could get exposure to crypto through, again, exchange traded funds, ETFs that track the price of it. So there are Bitcoin ETFs out there. We would be able to buy them for a client and hold them on our accounts. We don't advise on them, but if a client said, I want to buy something execution only, we can trade that ETF for them. Yeah.
Okay, excellent. Thank you so much. Thank you for answering everything so thoroughly as well. But I'm afraid that is all we've got time for. So we've covered so much in the hour. Of course, Simon talked us through taking the emotion out of investing and gave us his highlights, if you can call them that. I mean, are they highlights? I don't know. From the UK budget. And then Tom and Louis gave us an investment update on how we shouldn't focus on short-term volatility. Ali and Hugh explained how to plan for life events and why it's important to find a trusted advisor, before Katie gave us her insight on the current housing market and what might be round the corner. So thank you so much to all of our guests today, and thank you for joining us. We look forward very much to seeing you again next time. Thanks.